the S&P 500 is flirting with that huge resistance level at that $400 price. It is up almost 1% today, heading into a major catalyst coming tomorrow with the FOMC Minutes. And if you guys are unfamiliar of what this is, it essentially goes over what happened at the last Fed meeting. Why the Fed did what they did will be reported to you in that statement. You will also get the voting results. So you will be able to see if all Fed members voted for that 75 basis point rate hike, if one or two of them or potentially more of them voted for a 50 basis point rate hike, you're going to get the descending numbers. And that's what the markets really want to see, is some division starting to happen within the Fed. And that's going to be a key of tomorrow. But the biggest key is going to be what signaling the markets get from the FOMC minutes that will tell us how high the terminal rate needs to go, because that is the single biggest thing that the markets care about right now. It's not, are we going to get 50 basis points or 25 basis points? The markets don't even care about the number. The markets care about that terminal rate. How long is the Fed going to have to keep raising rates until they stop and get to that terminal rate? Last week, Fed Bullard shocked the markets and said the terminal rate is probably in between 5 and 7% based off of the Taylor rule. But there's a lot of variables of the Taylor rule. And this article right here from MarketWatch says why the effective Fed funds rate is already above 6% and why the terminal rate may be closer than you think. And this is basically using the Taylor rule in a different way than Fed Bullard did. And this way makes a lot more sense. And that's why we want to go over this here in this video, because it potentially could mean stock market bottom is in and you could be in for some more upside. Now, also, I want to look at hedge fund positioning and talk about kind of the good and bad scenarios from this catalyst tomorrow and potentially what could happen, because you also have Fed Jerome Powell that will be speaking here, not this week, but next week. And he's most certainly going to sound very hawkish yet again before you head into the Fed blackout period before that December 14th Fed meeting, guys. So let's get straight into it. If you guys find value out of the video, hit that like button and subscribe to the channel. But most importantly, have a great day, guys, and let's get straight into it. So first things first, let's talk about this Taylor rule situation. So the Taylor rule was created decades ago, 30, 40 years ago, essentially to say how high the Fed has to raise rates in order to calm inflation. And there's a lot of different variables you can plug in for the Taylor rule to come to a different number, essentially saying that back 30, 40 years ago, you would have to keep the federal funds rate at about 3% to keep inflation under 2%, right? Still that same logic of you need the federal funds rate to go higher than the rate of inflation, in which we have seen really throughout all of history with inflation. You have to get the federal funds rate, this blue line, higher than the red line to cool down inflation. But one thing that Fed Bullard was essentially doing with the Taylor rule was extrapolating data and really using the same calculations from the 70s, in which a lot has changed from the 70s to now. Like Fed Powell said at his last meeting, they're not concerned about over tightening because they could just say a couple words and the markets would loosen financial conditions. That is the big thing that Fed Bullard left out of this equation. And that's what this article goes into talk about, is essentially the federal funds rate is likely already about 6% based off of how markets have tightened financial conditions compared to the federal funds rate. For an example, the federal funds rate is sitting, let's go ahead and pull it up, at right now about 4%, right? But what are bond yields at? What have stock prices done? What has the dollar done? The dollars went up. It strengthened, right? Not good for equities, not good for American financial conditions. What have bonds done? Bond yields have went up, also hurting the stock market and causing financial contractions. When you look at real estate as well, another byproduct of the tightening and higher rates, but that has also helped to slow down the excessive growth and demand in the economy. When you look at all of these factors, it's essentially saying that the federal funds rate is already a lot higher and is already doing its job and pretty much we're close to that terminal rate. And the sooner the Fed figures that out, potentially the better it is going to be for the markets. But guys, we are already there, and I think that's where it becomes a very interesting situation, because if we've already done enough tightening but the Fed continues to go and continues to go, and they drive the federal funds rate to 5 to 7% possibly, then you're talking about massive tightening of the economy, and you will spill that over into a big recession, especially if you're at the higher end range close to 7%. And the Fed, they look at mostly lagged data, right? They're looking at inflation from a month ago. They're looking at jobs reports from a month ago. They're not looking at what is currently happening. So by the time you're already in this massive downtrend, it's already too late for the Fed. On the other hand, the Fed might take their foot off the brakes a little bit sooner if we do get some better inflation readings. Then we do see the labor market starting to cool a lot faster, and that could be very, very positive. The first indication of that will be coming tomorrow with this big catalyst, which is the FOMC minutes. Now, if you guys want to read into this article a little bit further, I just gave you a quick synopsis of what is said, then definitely go ahead and read it. Listen to it. I believe you can listen to it as well. It basically breaks down all the mathematics behind what I just said. I will link that down below in the description of this video. Nonetheless, let's get into this actual catalyst and what time it is. So if you guys are unfamiliar, the FOMC minutes comes out tomorrow at 2 p.m. and you have a lot of people saying, like this article, the Fed minutes may deliver a massive blow to the stock market, and I don't think they're wrong. As of right now, markets are prepared for a 5% federal funds rate, 5.25%. If we start to hear 6 or 7, that's going to automatically mean a lot of pain for the short term, and the markets are not necessarily expecting that. Let me tell you guys why. Because like I said, a 5 to 7% federal funds rate most certainly means a recession. Now, what do you guys think? Do you guys think earnings are going to go up in 2022, or do you think they are going to, or 2023, or do you think they're going to go down in 2023? Well, the average analyst has the stock market, the S&P 500, the top 500 companies in America, growing earnings at about 5%. If that doesn't happen, then you're in for a big problem, because we're extrapolating 5% earnings into the valuation that we are seeing right now, because the markets are forward looking. So we're sitting here at about the $400 level. If you're at the 410 level, which is just $10 to the upside from here, then you're sitting at about 19 times PE ratio. If you factor in a earnings drop for next year at these prices that we're currently at, you're expensive. And that's why the markets care about what the federal funds rate is going to do and where it is going to go. So if you expect earnings to be flat for next year or down for next year, you probably shouldn't be buying stocks that are up on the year, that are expensive, right? Maybe you can go bare basement bargain hunting, right? But you wouldn't want to buy your Apples or your large tech stocks, your FANG stocks. You wouldn't want to buy those stocks. And those are the things that really help to drive the markets higher. So here we are having a very positive day, but you know, tomorrow could get a little bit interesting. And that is to say the least. As far as tomorrow as well, you have a 17-week bill auction, a 8-week bill auction, and a 4-week bill auction. These will move the markets around quite a bit. This is essentially bond auctions, and you get to see the, demand for bonds, and depending on what that demand is, it drives up or down bond yields, which can give the markets pretty volatile moves once that information does come out. At 8:30 in the morning as well tomorrow, you have durable goods orders month over month for October, some initial jobless claims readings. If those come in light, that or like heavy, right? A lot of people are starting to file initial jobless claims. That could be a very positive thing for the stock market and could, counteract any, potential bearish news that we get, right? I'm not going to hold my breath for it, though. It says at 10 a.m. as well, you have new home sales for October, and that will also be important. But the main bread and butter of tomorrow is going to be the FOMC minutes. And especially if we're rallying 1% on the S&P here today, who knows by the actual close of the day, that could set us up for a bigger drop than not coming tomorrow. Typically, that is what tends to happen if you have a big green day before a potentially negative catalyst, a bearish catalyst like we are seeing tomorrow with the FOMC minutes. It can tend to lead you into some pretty red days. Now, if we take a look at the Ortex data and take a look at how hedge funds and money managers are positioning their portfolios, you can see there's been about 3,000 orders on the day, worth about $354 million, positive order value of 66%. So it's not in that, you know, high 70s to high 80% positive order value range. So you're seeing a lot more back and forth. This is the more bearish day that we have seen over the last couple of days. Believe it or not, even on red days over the past couple of weeks, you've seen a positive order value higher than 66%. But you have also seen more dollars head into S&P 500 options on a daily basis over the past couple of days and couple of weeks. You're getting into, you know, Thanksgiving, right? People are traveling, they're starting to go to their destinations. There's not as much actual trading activity going on, so there is lower volumes, which can make the markets very volatile. Overall, tends to make the markets go up, but it can make the markets go down just as easily. As you guys probably remember, some of you guys in 2018, when the trade war situation was going on in the markets, and essentially the markets crashed throughout the whole entire month of December. Typically doesn't happen, but when it does happen, it can be very aggressive. Now, what you're seeing from hedge funds as far as positioning is kind of giving you an indication, you know, that they're not all too bullish heading into tomorrow. Yes, it's still over 50% positive order value, so it's a net positive on the day, but it's not that high. And if you actually look at the options that expire for this Friday, out of the total open interest, the total amount of options on this Friday's expiration, 31.5% are calls, 68.5% are puts. So there's a lot more money essentially betting that the markets will head to the downside by the end of this week, guys. So that is basically going to be it. Thank you guys for watching. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Like I said, if you guys want to read more up on the Taylor rule and why we are already pretty much at that effective funds rate of 6% and why the terminal rate may be closer than you think, take a look at that down below in the description of this video. It will be linked down there for you guys. Thank you for watching, and I will see you in the next one.